Aditya Birla Sun Life Mutual Fund's annual investor meet, Voyage, was recently conducted virtually. Now in its ninth edition, the event saw a complete spectrum of thought leaders and market experts addressing India's growth journey and its future prospects post the pandemic. In this episode, Satyabrata Mohanty and Anil Shah, co-heads equity, and Atul Penkar, senior fund manager at Aditya Birla Sun Life AMC, will be in conversation with ET Now's Avan Dubash about the process of equity investing and their individual portfolio management styles. Let's listen in.
Welcome and thank you so much for joining in. Let's kickstart this discussion then by talking about a portfolio strategy for consistent growth. And Anil, just to take off from that title itself, consistent growth in a very challenging environment such as this. Look at where we are with crude oil prices on the rise. There's a geopolitical tension that's brewing on the brink of war. We're also seeing the overall macroeconomic situation that from the US Fed is seeing a very hawkish stance. Despite all of that, the equity markets are managing to hold out quite comfortably. The foreign equity investors as well are now starting to pour back money into the equity markets. And I'd like to begin with you and walk us through what you believe should be the prudent strategy for investors in terms of their portfolio allocation at a very challenging time like this.
Right. Yeah. So, as every fund manager across the world says, equity investing is the best way basically to beat, inflation on a consistent basis. And we now are in a world where, the biggest challenge that the world is facing is inflation. So from that perspective, the first thing that as investors, you should realize is equity in the medium to longer term is the best hedge against inflation. And, that's the first thing that continue your equity investing.
Which brings me to my question to you, Satyabrata, in terms of, portfolio allocation at a time like this when, one would say, I don't want to really get my fingers burnt in the equity markets. What do you think should be the adequate portfolio allocation to equities, looking at all of the other asset classes as well?
Yeah, see, as Anil said, equities are the best hedge against inflation on a longer term basis, on a medium to long term basis. That is because the earnings tend to grow along with inflation. So that is how the hedge is created against inflation. At least partial hedge is created. So just to go back a little bit, around 2.5 years back, we were telling that now is the time to change your portfolio allocation, and have a massive tilt towards equities. So if your normal allocation was 60-40 and ratio of 60 equity and 40 debt and others, so that is what the traditional allocation typically people keep in normal times. So we said that it is now the time to go shift towards equity, change the allocation because we were extremely bullish at this point in time. But now, considering there are a lot of things that have cropped up, mainly in the form of inflation and expectation of interest rates hikes happening, commodity price shocks and war. So typically a few of these items, when they go to extremes, typically they create a lot of problems for growth, the GDP growth across the world. So considering that kind of scenario, my advice would be to go back to a natural allocation of around 60-40, moderate it, and then take it forward as things evolve.
Yeah, and Atul, it seems to be, a consensus call that, allocation to equity clearly is the way to go. But at a time like this, what do you think would be some of the key factors to keep in mind while investing in the equity markets in order to ensure, as the theme of the discussion suggests, consistent growth? Because at a time like this, we are looking at a little bit of a tentative setup.
I think, if you look at investment into equity markets, particularly from, say, retail investor point of view, I think it's important to understand that equity markets, whether it's Indian markets or global markets, the inherent nature of equity markets is they are volatile. Okay, so to tide over the volatility in the equity market, one has to stay invested. Okay, and there are opportunities which the market always provides, whether it is in form of higher rate increases in the US, or whether it is the uncertainty because of Russia-Ukraine war. And these are the opportunities which the market actually provides. I think the best strategy is to stay invested and stay invested for long term. And obviously, one can stagger his investments either through SIP route or through a lump sum depending on one's comfort level. But I think what is more important is investor has to understand his own risk appetite and accordingly, allocate his own money towards equity and fixed income. I think that is very, very important.
On that positive note, then I'll wrap up the discussion. Thank you so much, gentlemen, for joining in and sharing with us your insights and your investment philosophy for consistent growth.
Thank you.
Thank you.
Next, in a very engaging session, distributors from across India join in to give a comprehensive insight into how things have changed on the ground and why time in the market is still more important than timing the market.
With the new India, which we are talking about, is the millennial India. People are shifting their asset allocation, SIPs have started. So today, the market, what we are staring at is perhaps not because of the old timers who are putting more money, it's the new Indians who are not going towards fixed deposits. When you talk to your clients, are you also getting a sense that this is a long-term, multi-year trend?
Oh, totally, Nikunj, totally. The kind of changes in the dynamics which I'm seeing on the ground, the pulse of it is very, very different than what I saw like 15, 16 years back when I started this journey, right? So today, everyone is in a fast track mode. Everyone wants to retire early, and that's something. So my pet pitch to our clients is, look, you working from 9 to 6, basically, that's your active income. But what about your passive income? Unless you build a kitty of passive income, which works from 6 in the evening till another day, 9 in the morning, right? Then you're really not building something out for yourself. And that pitch particularly has worked very well with our set of investors, basically, who wants to create a passive set of income, who are in that fast track mode to retire early, who want to interact with us more digitally, basically, and who want to explore different types of assets and different types of offerings, basically. So yeah, you're right. I think the demographics, the patterns, the behaviors, the psychology behind investing has changed dramatically. And the trend of investing in FDs and gold and everything has gone through phenomenal change and shifts, I would say.
Rajesh, we are feeling very happy. I remember when we were doing the first edition of Voyage, the most important trend was that we would track the FI flows. More than earnings, we would track the flows. Today, FIs have been selling in Indian markets are not even sneezing. There was a time when FIs would sneeze and we would catch a flu. That's largely because of domestic investors. Now you have the pulse of the market. Aapko kya lagta hai, Rajesh ji? This entire SIP flow, money into balance fund, money coming from FD to equities, that's a multi-year trend?
Of course, Nikunj, there's a complete change in the human behavior, in the investment pattern of the client. So there was a time at that people used to follow the traditional way of investment, and those were only fixed deposit, or the buying LIC policy, or people have some more money buying the property or plot and etc. But nowadays I feel differently, totally different behavior. People come and ask for the mutual fund. They understand the equities. People, even the new generation, right now I'm being approached by a lot of young guys who have just recently started their jobs and they started their career. Even they're looking for the direct equity. Even they just all want to make quick bucks in the markets, and they're not afraid. Even I'm sometimes, Nikunj, I'm just get perplexed. Young investor buying call and put and asking me certain times of the guidance about the call put options. Even they all are in hurry to make quick money, where we have to teach them the basic principle of investment, and they have to stick to their asset allocation plans. So a lot of things have changed, and definitely this is the change in the human behavior which has helped the Indian market to recover from the sharp, this strong sell-off from the FIAs.
Rajesh, why do you think aisa ho raha hai? Why do you think that there is a shift in approach? There is a shift in portfolio planning.
So in my opinion, I think the emergence of nuclear family is one of the biggest reason why people have started thinking that savings and investments are very important, because now they have to take care of themselves. The other thing is that they have witnessed the growth of the equity markets and the investment market in the country. They have seen that their friends, colleagues, relatives are making tons of money in their investment portfolio. And so it's catching fire. People have experienced investing over the years, and thanks to AMCs as well as the distribution fraternity, they have been able to reach out in scale, in crores of families to tell them the power of investing. So I think it is irreversible. Now people have understood the concept of investing, and the job, I remember 20 years ago, I have to tell them what is mutual fund. Then I have to tell them after 2-3 years what is SIP. There's a huge difference in the sentiment of people. For example, this Russia-Ukraine war, we did not get a single call from a single client in terms of what is happening. They are so okay with it क्योंकि मार्केट नीचे जाएगा, मार्केट ऊपर जाएगा, SIP बढ़ा देते हैं और पैसा डाल देते हैं. 10 years ago हमारे पास ये कॉल नहीं आता था, बाजार गिर गया तो पैसा डाल देते. अभी क्लाइंट सामने से फोन करके बोलता है कि बाजार गिर गया, is it the right time to invest or not? So I think this nuclear family concept, the emergence of market, 50,000-60,000 index, people, there's a feeling of losing out. If I'm not there in the market, if I'm not investing, I will miss out on something.
Navlakiji, I'm going to ask pretty much the same and the obvious question. What are you telling your clients? And आपके पास जो एक broad advice है, or what is the best asset allocation? What is the best strategy for 1 year, 3 year, 5 year, and 10 years?
Market is not difficult. Ups and downs are not difficult. Holding the emotion of the client and making him become aware about certain things. And I think the biggest issue I face, at least, and I tell my clients this, sometimes they don't know that they don't know. And that is the most difficult part. If they knew that they didn't know, it is easy to explain to them what we think we should explain. So that I would think is the way to look at markets. I don't pay attention to the noise of whether it is 59,000, 50,000, 75,000. For absolute terms, inflation adjusted, market will always go up as long as you keep the base as 100, 1979. वो तो ऊपर ही जाएगा. I mean, people say, I'm surprised that it reached 50,000. When it was 20,000, I thought it will never reach. Now I'm saying you should not be surprised it reaches 1 lakh, it reaches 2 lakh, 3 lakh. The question is when and whether, you are going to take benefit of that increase. So I agree with Brijesh that, you have to be cautious. Don't get greedy because when things are going right, it seems like I don't need any advice. I can do it myself. जहाँ भी मैं arrow या dart shoot करता हूँ, 100 points ही मिलते हैं. So the whole board is one bullseye. But at some point, your vision improves and you start seeing only the middle is bullseye and everything else is minus points. So keep that in mind.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2022, partnered by ET Now. Up next, we have KV Kamath, veteran banker and former chairman of Infosys, sharing his outlook for the BFSI sector. Let's listen in.
Mr. Kamath, for the banking sector, the worst is behind us. That is something which I think we can establish with a lot of authority looking at the NPA cycle. But are we at that decisive turn for the banking sector where the next 3 years would be radically and dramatically different from the last 3 years? Is the Indian banking sector at the cusp of a very strong cycle?
Indeed, yes. And it's an unequivocal yes. There are 2 or 3 reasons. The primary reason is what is the health of the balance sheet of the Indian banking system. I think it is more pristine than it has ever been through my long career in banking. Because the cleanup of the last 3-4 years has flushed what was not needed on the balance sheet, and injection of fresh equity has made you all that more healthy. So I think that's the first lever. The second lever a banking system requires is the economy. Is it facing headwinds? Is it facing clouds? I think if it were to face clouds, it was last 2 years. But the way we have come out of it, the way the country has managed the system, and thanks goes to the leadership in terms of the Ministry of Finance and the Reserve Bank of India, to keeping the system resilient, I think has again augured well for the banking system. The last point here is, does the economy have room to grow? we have a 25-year runway. So you got clean balance sheets, you got a supportive enabling environment the regulator has set up, and you have room to go headway for the next 25 years. What more could you ask, Nikunj? So I think the banking system should be set to grow. I'll add one more. You are working with, I think, technology, I would say, advances, which again are so exciting. Banks could do so many things with the new technology available. At what I call free mein milta hai. All these technologies today are virtually free, or you can actually beat down the guy across from you to get what you want at a very low cost. So banks, I don't think have ever had it so good.
So, Mr. Kamath, how exactly do you think this credit cycle will be different from the previous credit cycle? Previous credit cycle, in a sense, was led by commodities, steel, cement, power. Corporates have learned not to overcommit, not to over leverage, and the economy is coming back. So how do you think the cycle would be different purely for the BFSI sector?
That's a very interesting question. Throughout my time in banking, neither the corporate was having the degree of cash flows, free cash flows, that one would have liked to see. Myself as a banker and the client himself. So if you remember the old pattern, 20% equity, 80% debt. That is, incremental project was funded with 20% of what's called promoters' contribution, 80% debt. It was not because that was the ideal structure. That was because there was no other way you could have funded a project. And I'm going back now 40 years, 50 years into how it was done. In the last 10 years, that has been dramatically corrected. And I'll come back to that in a moment. And so has the cash flow of the retail borrower. 20 years back when the housing loan and the credit card cycle and the car loans, all these got off, the lay customer also was, in terms of surplus cash, a trickle. Today, his own, cash flow has improved. So both the bank's corporate customer and the bank's retail customer have much healthier cash flows today. So to me, that is the signal change between even 10 years 10, 12 years ago and today, in terms of what is happening in the system. And that augurs well when you're again also looking at a growth in terms of 8 to 9%. And I always love to say, you add the digital pie on top, that's 1/3 of what it is in some of the other economies. Even if it is 25% for us, or say a third, we're talking of double digits comfortably. Double digits should throw up banking growth of almost 13 to 15%. And of course, then you can work what should be the economic trajectory. I think it should be as fast as what the government has in mind.
Just a question here is on digital capabilities. What do you think, like, basically, where is India compared to Western countries or the other emerging market countries, especially the digital capabilities with respect to banks and also maybe the entire industry, all the other industries as well?
There are 2 or 3 factors to be looked at here. If we look at history, we were always with a lag of 5 to 10 years in getting technology. Up to 96, technology could not be gotten freely, the duties, taxes, and so on and so on. But then there's a lag. In the last 10 to 15 years, that lag has become virtually dead. There is no lag at all. It is real-time technology transfer happens. It's on one part. Second is our capability to develop technology. Till a few years back, our capability was to be the software doctor to the world or the software engineer to the world. But today, if you look at the startups that have happened, these have all played with technology and set up, I would say, platforms. I'm using the word in a much broader context than people tend to use, which are of value to end user and then customer. And when I look at the platforms, it's very clear to me, whichever business, whichever area, just digitech, fintech, whatever, you see one thing very clearly. These are full of value. So they have managed to embed value into the platform, which is the skill of and the mindset of these new startup companies, and you have to commend them and laud them for it. But I would look at it, my interest in technology, at the value that they've created in the platform that each one has put on the table, as it were. It's stupendous. It is absolutely fit for purpose. So that momentum that we have in creating these things is something new. We will create platforms initially for India and then for the world. Let's take one simple platform I think is fit for the world is UPI. UPI to me is a game changer around the world. And we can be all proud that it is an entirely homegrown product which has stood us in great, I would say, use in the last 2 years. And I think is ready for the world.
Next up, we get a closer look at how the falling interest rates and new tax rules have changed the fixed income landscape in India. Here are the highlights.
Bhupesh, looking at how equity markets have panned out in the last 2 years to the kind of scenario that we're currently at, and tomorrow, in all likelihood, we are going to see the beginning of the interest rate cycle actually change here in India as well. Does fixed income investment even make sense? Or should one really sort of stick to equity in this rising interest rate scenario?
So, 2 points here. One is in terms of asset allocation, we always recommend to investors that you should always have some allocation to fixed income, some to equity, gold, etc. There's typically a negative correlation between fixed income and equity. So typically when growth has fallen significantly, fixed income gives good return. So that's point number one, the asset allocation part, where fixed income should always be a part. So there are like 3 sources of return that you get in fixed income. One is the YTM, the carry part. Second is the capital gain parts, which is that, when bond yields go up, you get a capital loss and vice versa. And the third is the roll down part, which is, if yields are very steep and you've invested in a 3-year paper, in 1 year time, it will become a 2-year paper. And because yield curve is very steep, so you get a roll down benefit because effective interest rate for you have gone down. So one thing to note is that first is that yield curve currently are extraordinarily steep. So if you are at least at about 4-5 year point, both in the GSEC curve and SGL curve, and also in the corporate bond curve. So if you are, depending on your horizon of investing, if you are suitably placed in the yield curve in a somewhat quasi-passive way, and let the yield curve roll down and roll down the yield curve and get benefit out of that, you will still get a decent return. We have been advocating this strategy since last 1 year, and in a scenario, if you compare, in the last 1 year, 10-year GSEC went up from 580 to 680. Repo rate was extremely low, but even in that scenario, all these roll down strategies have given pretty decent return, 6% plus return. So a lot of decent return you have got despite this rising yields because of these benefits. That's point number one. And point number two, more importantly, is that, as I just discussed, the actual return that you get in fixed income is a function of not what is there, what is going to be the rate hike cycle, rate cut cycle, but what all is already factored in the prices. So, markets are like discounting machine. If markets have already discounted that there's going to be a rate hike cycle, and rate hike cycle turns out to be lesser than what markets have discounted, you will still do much better than you are sitting in cash. And because markets are already factoring in 200 basis point rate hike, if you look at the swap curve over the next 1 year, and most likely are they not going to hike that much. So in most scenarios, you can play with. I think fixed income still make a lot of sense to invest.
Sure, makes sense. Sunaina, the conversation is not going to be complete before knowing what your tilt towards the market is. What are the sectors that you think are going to outperform, and which are the ones you think are going to underperform from here?
So, I think, as I was discussing earlier, credit health in India is doing extremely well. We're probably best placed. And when I'm saying credit health now, I'm talking about the organized players, the ones where, investment grade, where mutual funds would actually invest. So across the board, actually, from a health perspective or an underwriting perspective, you're spoiled for choice. A lot of sectors doing extremely well. I would be a little cautious about sectors which are more contact oriented because, you never know when there is another resurgence of a COVID wave, etc. And also the bottom of the pyramid of both the household balance sheet as well as the corporate balance sheet. So, that's where you would be a little careful. However, you don't expect any nasty surprise from that either because, all the NBFCs which cater to those segments are extremely well capitalized and leverage is low. So, there are a lot of good companies and good sectors to go there and pick from. The challenge, of course, remains on corporate bond spreads. The AAA spreads, AA spreads, single A spreads are at all-time lows. And, that's where the challenge still remains.
Bhupesh, Sunaina, both of you, thank you so much for taking the time out and speaking with us.
Next week.
We think that gold has a place in the portfolio. Gold is a strong place in the Indian heart.